So now we come to Asia, we come to China, and some of that geopolitical backdrop that we've seen in general, because there's a lot that has happened over the last few weeks that we wanted to catch up on. So this is just looking at Australia and just kind of connecting what we spoke about at the end of the last segment, where the PMI came down across the board. When you look at services, was down from 56.8 to 44.2. Composite 56.7 to 45.2, but manufacturing was only down from 58.6 to 56.8. So we do expect to see a bounce in services as some of these restrictions are lifted, just because they were more aggressive on their lockdowns. When you look at how they've been treating COVID, I just want to talk about Australia for a minute, because you might be thinking like you haven't talked about Australia for a while, and it's because it's very important to look at how they're going to be linked into Japan and South Korea as we go forward with some of the issues that we're going to discuss between the U.S. and China, which Australia becomes very pivotal given how much resources they have, and how Japan may look to rely on them more and more, and turning away a bit from what's happening within China and some of the issues that remain there. Then when we look at CPI, shockingly, I know, shocking, right? CPI continues to grind higher as inflation continues to rise. And that's something that, again, we keep talking about. It's everywhere. It's not just the US, it's throughout the whole system and the whole chain. But it's going to be important to see how does the relationship, the trade, continue to grow, and is there ways to try to minimize or replace or at least adjust some of the supply chain to from where we sit with China right now. So then when we look at Japan, Japan is having their own increase in COVID cases, as we talked about in the EIA show yesterday. And yes, for those that are wondering, I am wearing the same shirt because we do film all of these together. And unfortunately, as we were just joking offline, the producer and our assistant is, or I should say analyst really, is forced to listen to me talk from 12 p.m. till about 4:30 p.m. So that's unfortunate for them. But then when we look at Japan, there's a lot of slowing that's happening. So when we look at what's happening this far, let's look at supermarket sales. So supermarket sales have come down a bit versus prior machine tool orders. But when we look at PMI, you can see PMI is really flatlined, where manufacturing was at 52.4, now 52.2. Services were at 48, now at 46.4. PMI composite was at 48.9, now 47.7. So you're seeing this slowdown in services, but you can say that there's COVID cases that are increasing, which is 100% accurate, but they were slowing before that. And even before they were putting in some of these alerts and some of these lockdowns ahead of the Olympics, there is a bigger and bigger problem that's coming into the Japanese system that is equating to some of these slowdowns. When you look at June, nationwide department sales were down negative 1.6%. Tokyo department sales, same thing. PPI services, though, and PPI went up. It went from 1.3%, which was expected, to 1.4%. So you're still seeing the steady increase in pricing, and then that is getting pushed out into, because they are a huge exporting nation, and that's getting pushed out into additional price increases around the world. So then when we look at South Korea, a little bit slower. GDP year over year was expected 6%, came in at 5.9. GDP quarter over quarter expected at 8.8%, came at 0.7. But discount store sales year over year was negative 2.4%. Department store sales at 12.8%. Retail sales 11.4%. And consumer confidence in July last month was 110.3, now 103.2. And you're seeing, again, the Asian side, you're seeing some of these slowdowns that continue to roll out and are going to weigh on just where some of this global recovery looks like, because it's a lot of the global side of this rally, if you will, is really beholden to Asia and the growth that Asia sees. And we're in the end of July now. And we're seeing some of this, the problems that remain, the issues that continue to come through. And I think this is going to be a bigger overhang and indicative of some of the other problems that we're seeing that are really starting to play out. Again, this is some of those issues that I don't know if they're appreciated as much in terms of some of the slowing that is happening within Asia itself. And then With that being said, South Korea leads semiconductor equipment spending surge, U.S. exports of semiconductor manufacturing equipment. So where is that equipment going to? Well, it's been going to mainland China at a greater clip. Taiwan has come back a bit. They're actually going to be building something within the U.S. as a team up with Taiwan Semiconductor. But look at South Korea. It's exploded. And that's because we're trying to increase our share or our trade with countries like Japan, South Korea, and Australia. And now we've actually put new sanctions or limits on what can go to mainland China, because look at where this is from January 1st to May 31st of 2021. So remember, there's been new limitations on the sophistication of the equipment that can be sold to China under these new sanctions. So this has actually started to come back down. So then when we look at Japan department store sales, that's looking at it overall, you can see it's just back to where we were in 2020. Japan isn't getting back to where it was, and look how consistent it was over that time period, speaking to some of the issues. And then let's look at South Korea. South Korea GDP has yet to get back to the trend it departed from in 2020 with COVID. And this is with record amounts of exports, imports, record amount of trade. It's just the local consumer just isn't there. And that's something that's reverberating through the Asian system of just not seeing that consumer show up. So now let's pivot a minute into Asia and India and China. So this is looking at Pangosoo, which is 6 months after the disengagement between India and China, shows the PLA, or the People's Liberation Army, forward base in the area, housing troops not far from the agreed no-patrol zone. The image also underlines how the border conflict continues to be an existing issue between both neighbors. So when you look at what's there so far, so when you look at tarped accommodations, site entrance, defensive trenches, when you look at how this is being constructed, and remember, this is the area of disengagement. So this is the reservoir down here, the Pango. And when you look at what this is, this is the line of actual control. So you can see that they're not that far away. This is the new forward base. So a new forward base has been created. Yes, they did pull back. There was some of that movement away from the LAC, but it's still very close, and it's new accommodations. And this is where, as we said, I think it was now 4 weeks ago, that there is about 200,000 additional troops on the Chinese Indian side at these hotbed points, which again continue to be in the Doklam Plateau, in Sikkim, and especially when we look at Ladakh. So not only is that an issue, but then we have to discuss what's happening in Afghanistan, because there's a certain amount of cross-pollination into Turkmenistan, into Iran, and we're seeing a lot of friction in some of these areas, especially when you look at the Iranian backdrop bordering Pakistan and Afghanistan. There's means for them to get arms into civilians' hands, and you're seeing some of that happen as some of the riots and demonstrations in Iran accelerate. But when you look at what has happened so far, so when you look at what the government controls and how important some of these strategic areas are, you can see the problems that continue to arise when you're looking at just logistically and the supply chain. So as the U.S. pulls out, we have seen essentially a power vacuum that the Taliban have been able to come through and fill through this point in time. And each circle is just looking at the value of imports and exports in 2020. So when you look at, how is the Taliban going to finance themselves? Well, they control two places that account for almost $2.4 billion of trade. So that alone is going to provide opportunity. That doesn't include the opium, the poppies, and all these other pieces that can come out of that region. But this is some of those why we've seen a pause, if you will, of the U.S. withdrawing from Afghanistan, because the movement or the progress the Taliban have made has been very concerning, and I think you're starting to see a little bit of an adjustment in how that's going to be addressed over the next few months. So now really turning into, updating on China. So first, let's look at where do we sit with the U.S.-China purchase. So clearly, we're still well off of where we should be right now in terms of target. So 69% of target for Chinese imports, 64% of target for U.S. exports. So again, we're still very far away from where we're supposed to be when you look at what that the Chinese-U.S. trade deal is. So then when you break it down into its pieces, agriculture, even with all of the purchasing that we've had in terms of agriculture, there's still only 87% of target. And this is based on price, not volume. So think about how high grain prices have gone and where they still are missing that level. So then when we look at manufactured goods, 66% of target. Energy is never going to be close. They're 52% of target. And uncovered is 13% over target. So they've actually been able to essentially hit that level. So then when we look at U.S. exports by product type, again, you're seeing the same thing play out over and over again. And this is, again, why we're just not going to see this trade deal. We said from the beginning it was to have one. It was never going to be met, and it continues to be the case. And just think about where China's supposed to be in a recovery. China's supposed to be growing. We've argued against that tooth and nail for over a year now. But that's the mantra. That's where we're supposed to be. So if you're supposed to be so strong, why are we still so far behind? But then it gets into the geopolitics. So let's look at some of the disagreements. So on Monday, the U.S. Deputy Secretary of State, Wendy Sherman, held talks in Tianjin with her Chinese counterpart, Xi Feng, and it didn't go well. But not that, for those that have been following us, that is of no surprise to anyone. And it was very similar to what happened in Alaska. So let's look at some of the list demanded that what was asked of the U.S. Lift visa restrictions on party members and Chinese students, stop suppressing Chinese companies, stop registering Chinese media organizations as foreign missions, drop the extradition case against Meng Wanzhou. The second list expressed Beijing's specific concerns over issues including unfair treatment of Chinese nationals and diplomats in the U.S., growing anti-Chinese sentiment in the U.S. So here's a direct quote regarding North Korea. The U.S. cannot expect cooperation on one hand and to hurt China's interests on the other. This won't work. It seems that a whole of government and a whole of society campaign is being waged to bring China down. Again, this is continuing to be an issue, but it doesn't stop there. It continued to go on. So then when we look at what happened going forward, well, let's, Xi Feng's boss, which is Wang Yi, he stepped in and said Wang wasted no time broaching those thorny topics that we love to talk about. That the U.S. must not challenge or subvert China's model of governance, interfere in China's development, violate China's sovereignty or territorial integrity. If that isn't a shot at the South China Sea and Taiwan, I'm pretty sure I don't know one. So that is going to become, I think that right there is, again, just driving home the points that we continue to see. And there was comments against Joe Biden. Now, mind you, this is essentially a quote from Mark Rossano in December. Before, let's call it 3 months before the election. The new U.S. administration has continued its predecessor's extreme and erroneous China policy, constantly challenged China's bottom line, and stepped up containment and suppression on China. The great rejuvenation of Chinese nation cannot be held back by any force or country. I didn't say that what we did was extreme or erroneous. I just said that Biden or Trump was going to keep these policies in place. And they're now freely admitting what we already know, that Biden has kept them and none of them have changed. If anything, they've actually gotten stricter. So I think that is an important caveat to look at, where if China was looking for a friend in Biden or the Biden administration, I just don't think that they're going to find one. And so far that has been proven accurate. So to improve strained ties, Wang said the ball remained in the U.S.'s court. The U.S. side must make correct choices as to whether the bilateral ties will head to confrontation or improvement. Find a way for two major countries with different systems, cultures, and stages of development to coexist peacefully on this planet through dialogue. So again, you're hearing that they want it, but they keep laying the blame at the feet of the U.S. So now let's look at, well, what is happening with China? Why are we seeing some of this strife? Why are we seeing some of these issues as we've talked about, wolf diplomacy, the failings which they're trying to soften up. But when we look at Vice Premier Sun Junlan and several government ministers participated in a discussion. And what was that discussion? It was about trying to increase the birth rate, because there is a huge problem with the birth rate. And one of the things that they're trying to do is offset the cost of paternity, maternity leave in order to try to incentivize additional procreation. So we cannot have the government place in the order and ask businesses to pay the bill. It's imperative to set up a cost-sharing mechanism. So I think that's an important caveat to look at when you're trying to say, how are they going to adjust their issue when you look at the growth profile? But when you look at China's monetary easing, was among the world's most conservative. And it's important. So this is cumulative cuts in central bank policy rates in 2020. Major economies, not a zero bound. So when you look at China, as we've been saying before, China had already stimulated a significant amount from 2016 to 2018, and then again in 2020, but only to a degree because they didn't have the ability to issue, because as we're seeing now with Evergrande, Yuan, there's so much off-balance sheet debt that is being found and discovered, that there's only so much liquidity. Because remember, they've had such an easy policy with so much debt to GDP, so much leverage already in the system. They don't have the capacity nor the runway to increase that to any meaningful side, which is why when you look at the Evergrande bond prices, the Shanghai Stock Exchange Property Index, all of these things are coming down. And remember, you have to look at what the CCP says and how they're structuring policy, because typically the data will look fine. Data will look great, but you have to look at what are they going after. So when they said that they're going to do the dual circulation strategy and they were going to try to stimulate the consumer, you knew they were going to have to admit the consumer was weak, and they were trying to get in front of that. But we already knew that consumer was weak. So we already knew that the property plays, all of these guys were over levered. But when you looked at what the CCP and the PBOC were saying at the end of last year was, again, go after property managers, go after real estate, go after, and so we knew there was a problem. We're just now finding out how big that problem is. Now, it's great that China's trying to get in front of it, but again, you're just now getting a full handle on what those overhangs really look like. So then when you look at what's coming due, you can see that the Evergrande needs to repay some $7.4 billion of maturing bonds next year, which again, when you look at their waterfall, that you can see just how they're going to have liquidity events really through 2023, which is going to become a much bigger problem or at least them trying to get in front of this and try to do something to offset what these issues are, because there's a lot of contagion. Because look at where the Evergrande empire spans. It spans across multiple different sects of majority owner, minority owner, of technology, of electric vehicles, of real estate, of life insurance. This is a big problem. And that's why when we talk about the issues in China, everyone likes to say, well, it's not a big problem, they'll find a way to pay for it. But there's a lot of contagion. And that's what when you look at the U.S. and what happened in 2008, when Lehman fell, there was a lot of contagion. And now these guys are way more levered than Lehman ever was. So there's a bigger problem. And when you look at what they're trying to do, it's ways to offset some of that pain and some of that struggle, because there is this big overhang. So then when we look at that borrowing spree, leverage positions in China continue to build. So when we look at what happened as the Chinese market came down, entered into a bear market, the outstanding margin debt on Shanghai Exchange exploded to an all-time high. So this is also people buying the dip on leverage. This, again, leading to some additional problems that we've seen in other markets so far. And then when you look at what is going to happen in the Chinese yuan versus the required debt. So when you look at what they're trying to do, they're also trying to help devalue the yuan, and they want to bring it down because it's a way to help be more competitive in the international market. But we're so far not seeing that type of movement, and you've seen it stay fairly elevated, and that's where we're going to have to watch, because if they can cut some of the yuan into the international market, that will allow them to pass through a bit more inflation without driving up the price to such a point. And it opens up, because if you devalue your currency, again, it helps to adjust some of that trade balance and incentivize some additional trade, which is something that they really need to do to help support because they're slow on the consumer side, they're slow on the investment side, they're slow on the real estate side. So in order to hit their target number for the year, they're going to need something, and subsidizing some exports is a way to do it. But when you look at the ex-factory producer prices, you can see that they're still at near all-time highs, going back to 2008. But yet consumer goods CPI is still low, but disposable income for urban households is only at 4%. So when you look at how disposable income has dropped, they can't raise CPI because nobody can buy anything already in China. So they have to turn to the export market, and they're trying to compete more, but they have to pass through those prices to someone. And if it's not going to be the local consumer, it's going to be the international market. But when you look at the weakness that's coming into the international market, they have to reduce those prices somehow. Easiest way to do that is a weaker yuan. So subdued manufacturing investment recovery despite robust exports is the other problem, where, again, speaking to the investment shortage, which we just talked about, investment has been very slow. And if you look at the GDP calc, in order for them to hit their target number, something is going to have to pick up. And it's unlikely that we're going to see this investment, because when you look at the CapEx expenditures from micro cap all the way to mega cap, you're just not seeing that really carry out. So then when we look at the China margin balance against the Shanghai CSI 300, you can see that it just continues to grind higher, which then could create an even bigger movement to the downside. Because remember, in China, it's very difficult, if at all, to short. So a lot of these individuals are buying. Now, if selling pressure continues to mount, then the cost of holding this on margin gets more and more expensive, and you're going to have to either post more collateral or be forced to sell, which could also become a much bigger liquidity event over a short period of time. Now, we talked about retail sales, but we just wanted to wrap this up because it's important to kind of highlight what we're talking about. Because when you look at the national numbers, there's a lot of things that they can say, but when you go into the province, so on the provincial level, on the local level, which is why we keep talking about what we're seeing at the local level is not what we're seeing in these numbers. And on the local side, you can see that 2020 versus 2019, how slow some of these sales are, and anything that was above 0% is actually getting a bit worse. Then when you look at it as 2021 versus 2020, you can just get an idea of just how slow this continues on that 2-year average, and how we're just not seeing a big pickup, or I should say recovery at all, when you're looking on the consumer side. If anything, it's only getting worse, speaking back to the reduction of disposable income. So retail sales changes in Hebei, you can just see just where things sit and how weak they have been through 2020 and into 2021. And you get this bounce back, but now you're starting to roll back over. Now they're also facing floods. With floods, what are you going to get? You're going to get a destruction of corn crops, and that's going to impact what people can eat, what people can afford, what kind of tax revenue the area is going to be able to raise. And so the size of China's overseas shopping market, you get an idea of just where the shopping is and what some of this exposure is going to be over this time period. So again, there's a lot of problems that continue to arise. And so far, the market, I don't want to say it's swept it under the rug, because you've had a fairly big correction in China, but even though the equity markets have started to rationalize that on their exchanges, you're not seeing how the contagious. This is the second largest economy in the world. It's the largest exporter in the world, and it's the number one. The U.S. is the number one importer. So there is I should say number one trade partner. So there is a bigger problem afoot, but with what Powell is doing and a lot of this stuff continues to get glossed over. And I think it's important to understand that as much as we're separate or different, we're still very much linked. And those are some of the concerns that we continue to have as the U.S. market shakes off the slowdowns in Asia, especially China. So I know we covered a lot, a lot of content out there. So if you have any questions, please let us know. We love the feedback, love the back and forth and comments. You can find me on Twitter at Mark FNY and or at email at mrosano at c6capitalholdings.com. So thanks again for watching. I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.